Welcome to The Explainer. Today we're sitting with something a little strange in the middle of the risk world, a multi-billion-dollar industry that exists entirely to protect businesses from digital disaster, and yet from what we've found seems tangled up in its own confusion and quiet skepticism. Any business running on systems and technology, which these days is practically every business, buys this kind of cover hoping for one simple thing: certainty that if disaster strikes, someone actually shows up. But the data is telling a much messier story than that. The very product built to remove that anxiety might in places be adding to it. Worth sitting with before we get into why. Section 1. The Cyber Insurance Divide. To make sense of this market, it helps to look at who's actually buying in. By one estimate, large corporates sit at around 75% adoption, which makes sense. They've got risk departments and deep pockets to match. Other sources put that figure a little bit lower, somewhere in the 60s, take that exact number with a grain of salt. But small and medium businesses tell a very different story. Adoption drops to somewhere around 20%, and for micro businesses, closer to 10%, which is a bit like watching the smallest boats skip the life jackets. And it's not just a size thing either. Geography plays a big role too, and the swing is bigger than you'd expect. US small business adoption sits at a fairly low 17%, while in the UK sits at a much healthier 62%. Make of that what you will, but it does suggest that this isn't just as small businesses are like this everywhere. Something local seems to be going on. Section 2. Confusion apparently beats cost. If you ask most people why a small business skips cyber insurance, the easy guess is always money. But one survey, just the one worth noting, found something a little bit more surprising. Confusion edged out cost as the top reason. 38% said they simply didn't understand the coverage, versus 26% who said it was too expensive. If that number holds up, it points to a communication problem, more than a budget one. These policies really can be dense. Jargon-heavy contracts, fuzzy definitions of what even counts as a cyber event, and exclusions thick enough that a regular business owner might genuinely struggle to know what they've bought. And look, nobody's rushing to buy something that they can't explain back to you. Section 3. The "it won't happen to me" fallacy. Stack a psychological wrinkle on top of that confusion. Apparently, under half of small business owners believe that they're actually a plausible target. The mental shortcut seems to be hackers only bother with the big guys, the massive banks, the household names. It won't happen to me. And oddly enough, the same blind spot seems to show up even among wealthy, high net worth individuals, at least according to one report, which is a little funny because you'd think money would buy a bit more paranoia, not less. But automated attack scripts don't check your net worth before knocking. They're just looking for an unlocked door. So this one assumption alone might be quietly keeping a lot of businesses away from coverage they'd probably benefit from. Now the part that's arguably the most interesting is Section 4, why some claims get denied. So, what happens to the businesses that push past all of that and actually buy a policy? Here's the part worth sitting with. According to the figures we found, something like 14% of insured businesses that filed a claim had it rejected outright, which, if accurate, is a genuinely rough way to find out your safety net had a hole in it. You did the responsible thing, paid every month, and still got left holding the bag. Why does this seem to happen? The recurring theme across what we read is policy non-compliance. Businesses not quite meeting the technical security requirements buried in their own contract's fine print. This is where that earlier confusion turns from annoying into actually costly. It usually comes down to some clause a business owner skimmed past or figured surely wouldn't matter. And insurers really do seem to enforce a fairly strict rulebook. Picture a hypothetical: your policy requires multi-factor authentication on every employee email account. One manager finds it mildly annoying, quietly turns it off, and of course, that's exactly the account a hacker slips through. Claim denied. Or your contract requires quarterly security training, but everyone's slammed 1 month, and it gets skipped. The following week, someone clicks the wrong link, denied again. The pattern, at least in what we found, is you have to hold up your end of the technical bargain, or the safety net just isn't there when you reach for it. Which leads into Section 5, a bit of rising bar, falling trust pattern. Zooming out, there does seem to be a bit of a feedback loop running through this whole market, though this part is more our own connecting of dots rather than a single hard fact. On one side, you've got insurers dealing with real ransomware payouts, appear to be tightening requirements and audits to protect themselves. And then on the other hand, as those requirements get stricter and as stories about denied claims circulate, buyer confidence seems to erode. Stricter demands, more confusion, more accidental non-compliance, more denials, less trust. Round and round it goes, at least as a working theory. Whether or not it's the full picture, it does look like a product getting stricter and less trusted at the same time, which is a strange place for any industry to sit. So, worth sitting with. If something happened to your business today, would your claim actually get paid? Or is there a chance you're relying on a safety net with a technical trap tucked somewhere in it? We can't promise you an answer, but reading your policy properly and asking your broker some slightly annoying questions seems like time well spent either way. Thanks for sitting through this one with me. Maybe go dig out your policy. No judgment if you haven't read the whole thing, and I'll see you in the next one.